Hey, what's up, guys? This is Bobby with Growth Vue, and today I'm here talking with Jeremy Cisneros. He's the Director of Acquisitions at the Growth Vue, and today I thought a good topic we could talk about is just breaking down a T12. Whenever I made my first two investments into syndications, I actually had no idea what a T12 was. I actually just started on Bigger Pockets, asking who was trustworthy, and then ran it by some friends and just invested money kind of blindly. But I think this is a great topic for people who are new to syndications and who need to have a good idea of what the numbers are whenever a sponsor buys an asset, and then how that sponsor views those numbers and what they want to do going into the future. So that's why we have Jeremy here. And Jeremy, man, we appreciate you taking some time to chat.
Yeah, excited to talk to you guys here for a little bit. I know it's a different topic than what you kind of think of as like a sexy asset, but it's for me it's as important as knowing the property itself.
Yeah. Well, awesome. Well, let's dive in. Can you just maybe in a simple way break down what a T12 is?
Sure. Yeah. So we look at a multifamily apartment complex like any other business, if you will. It's got revenue, it's got expenses. So just as any other business does, a T12, short for trailing 12 months, is a profit and loss statement of what the health of your business looks like. So starting with the revenue to the expenses and the what we call net operating income or NOI. And that's very high level. Happy to dive in deeper depending on how much you want me to get into the weeds there.
Awesome. Well, yeah. Well, that segues into something good. I think, like you brought up like NOI and you broke down what a T12 is. Like whenever you analyze a T12, what type of questions does that typically lead you to ask the prior owner?
Yeah. So you can discover a lot from a T12. And that's really why we always ask for that piece of documentation to figure out how the current owner or the current seller is managing that asset. So we usually will have an unlimited amount of questions, but some common ones are if you don't know the you know pricing guidance already, it's just good to have that so you can have an idea of what we call going in cap rate might look like. And then also, starting from the top again, the revenue, what units have been renovated, which ones are below market, at market, and above market. And when I say market, I'm just talking about the local area there, what comparables, subject property are, in line with what you would expect a tenant to pay on a monthly basis. So that's kind of the revenue and what other income they're charging. If you're stepping into the shoes of a tenant, you usually have, pet fees or sometimes you pay a portion of your utilities. It's very important to know because if you're buying an asset, you want to know where you have the ability to maybe squeeze a little bit more revenue or increase things here and there, as long as they're aligned with the market. And then it comes down to management. We hired professional third party management companies that manage thousands of doors who do this day in and day out, all around the markets that we look in. And without them, you know, we wouldn't be as successful as we are. We're asset managers, but the property managers are the ones, the boots on the ground. And I say all that because at the end of the day, if you don't have a good team, you don't have a good management system in place, then your expenses could get out of whack. They could, a few line items can increase here and there, and your bottom line or your NOI is going to be lower because of that. So it's just asking the seller about those things and making sure that they have good management in place. If they don't, that's an opportunity for us from how we see it.
Nice. Yeah. Yeah, that would be great to have a good understanding pretty quickly of what's been renovated, what's not. Are there, costs to have a pet and finding where you can increase revenue and improve the NOI. That's awesome. Um, are there what kind of common trends like for an LP, like someone who's going to be investing with Growth View or any sponsor for that matter? What type of trends would you say maybe are bad or alarming in the T12? And I mean, we're assuming that the sponsor is even taking this deal and giving that offering to the investor to analyze. But let's just say, what type of trends typically are bad in a T12 that should be concerning to an investor?
Yeah, no, that's a great question. Something that's a little more advanced, but everyone should be looking for it, especially as syndicators. You want to look again at the revenue, and it's if you have an asset and you're going to sell it, you want it to look as shiny and strong and positive as you can. Sometimes they'll throw tenants into the property, but they'll give them the first month or 2 months free, right? So what you got to look at is not only your vacancy, which is physical vacancy, but also your other aspects of, what we call loss to lease or concessions. If those are increasing as what we call a T3, which is taking the last 3 months of that T12 and annualizing that, if that average is way higher, then it's definitely a concern, a red flag. You want to ask the broker, ask the seller about those items. Um, and then if there's anything funky going on, just taking a look at the T12 in general and the T3, and where has the recent few months been as this asset's been preparing to go on the market versus where has it been more historically?
In the T3, that's the trailing 3 months, the last quarter, correct?
Exactly. Yeah. Yeah. That's it.
Okay, very cool. Sounds good. And then I know when you're analyzing a T12 or a T3, there are maybe certain non-reoccurring items that may or may not be on there. Could you speak a little bit about what those may be?
Yeah. So, and like any business, you're going to have fixed costs and variable costs. So, fixed are typically your things like insurance every year, they're pretty fixed, as well as taxes. And then your variable costs can include labor or utilities. They'll fluctuate month to month. And depending on how, taxes are paid, for example, you might only see them 2 months of the year, January and July, for example. So you want to just be cognizant as you're looking through the history that you're not missing any kind of large expenses as such, and take into account that expense is a large one. Just we always call the local county tax assessment office just to get a true figure there. So that's one of them, and then we just look for opportunities as well. Typically, you'll have them if your repair and maintenance item might be a bit higher if you're operating an older asset, 70s or 60s vintage. But when we go in and reposition this, our goal is to reduce the amount of repair and maintenance we're going to need in the long run. But up front, we're going to assume more conservative that it's going to be as is today. And, not to get into the whole CapEx renovation plan, that's below the T12, but that's ultimately our end goal, is to add value, kind of fix up the property a bit and reposition it.
Got it. Okay. And quick question: what are the core markets we're looking in right now, as far as like just geographic areas or cities? If you could fire a couple off.
Yeah, so we've liked the Carolinas, North and South
Okay.
Carolina, for a long time. The main triangle over there in North Carolina, getting really hot right now. So, we've kind of also pivoted a little bit to look at a little more secondary markets, somewhat tertiary. We really like the fundamentals behind Oklahoma City.
Okay.
Behind, we're looking at markets potentially like a Memphis. We'll see where those end up, but we really do like another market in Alabama called Huntsville. It's up and coming, and it just again, the fundamentals behind the population, the median income, and the growth that we're seeing in these markets have tremendous future projections.
Cool. I actually grew up in Mobile, Alabama as a kid. Went to school there. Huntsville is a
Uh,
beautiful area.
okay, there you go.
Cool. Well, the reason I asked that is I know a T12 could also have like certain like seasonal changes and things you may discover in there, especially if you're looking, further back than even 1 year, looking at prior years. In Oklahoma, there's obviously like tornadoes, in North Carolina, I'm not too educated on, what unexpected weather seasonal changes would be there. But can you touch a little bit on maybe like maybe seasonal changes that might happen in certain areas or
Yeah.
with certain assets?
Yeah, no, definitely. So we try to stay away from markets that have snow, for example. But there's some select markets that have snow and therefore potentially ice. And you have to think of how much land these properties are sitting on, how much parking lot and paveway you need to um, budget in for your snow removal, because if there's a heavy
Mhm.
winter, that could be pretty costly. And if the previous 12 months that you were looking at on your T12 wasn't, it could be an extra tens of thousands of dollars, just depending. So definitely something to keep in mind. Um, it's not too uncommon, again, in these colder areas that you have pipes that freeze, or these hot markets like Arizona area where the air conditionings are just overrun if they're getting to that point of age. So you have that kind of geographical seasonality, but then also, more so depending on where you're located too, insurance is a big one, and it can fluctuate, can double in price versus depending on where you are. If you're in, a hurricane prone area, or if you're in more of a lesser, more mild Mother Nature MSA, it's going to be lower. So, Houston and definitely the shore areas, Charlotte and those places on the Carolina coast are going to be pricier. So, again, although those are fixed, those will vary drastically. And then the last thing is taxes. Um, One of the big thing in Texas are the taxes. There's no state income tax, so the way the state generates a good portion of the revenue is through real estate property taxes. And for those who haven't invested in that state before, it's a shock to go and see how drastically going from Oklahoma to crossing the state borderline to Texas, how big of a difference that can make. And just all these things compile, and it's important to get familiar with your market that you're researching.
I'll keep the dad jokes to myself, but whenever you said Phoenix and the Heat, I was like, that could burn you on a deal.
Really can.
That's awesome. All right,
That's the one.
cool. Well, tell me a little bit about rent roll and like why that's important when you're analyzing the T3 and the T12 financial statements, and like what kind of impact that can make on decision making.
Yeah. So high level, the rent roll is also provided by the seller, the property management company, and it shows you, basically breaks out all of the units. So there's 100 units. There should be 100, um, unit numbers on this rent roll. It's a long, usually Excel spreadsheet, hopefully Excel spreadsheet. Sometimes it's a PDF, and that's another story. But you can pull out the information from that most recent previous month. How is the property actually performing? What rent is supposed to be charged? What rent is actually being collected? And you can aggregate what we call bad debt, or delinquencies based off of those collections. And it's a big topic as we go through the eviction moratoriums that are coming to an end here soon, because there's going to be a lot of, I think, in my personal opinion, turmoil, and you want to just, be cognizant again of what's going on for the actual rent collections. So rent rolls are very important. It sometimes gets overlooked, but it provides a very recent snapshot as to, this is the revenue I say I'm collecting, and this is what we're actually collecting. And then going a step further, oftentimes it'll have, this is what we think the market, again, should be charging. So if we were going to be charging market, that number is usually a slight premium to what is the in place or effective rent. So it's kind of a phantom number, if you will. It's kind of voodoo accounting, but it's important, again, to get an idea and do your own research as to, is there an ability to increase the rents as to what's in place or effective today?
Gotcha. Okay. Now, what gets you excited about seeing an underperforming T12? And I guess the frame of this question is like, I know if the more an asset is distressed, there's a higher opportunity for IRR, like a higher IRR, but the less distressed it is, maybe there's less value add, but there's also less risk, I would assume, right? But like, what type of things maybe get you excited about an underperforming or just kind of lackluster T12, would you say?
Yeah. Again, the big levers are going to be the rents, sometimes other income. If there's just no other line items of income, those are always pretty exciting, including RUBS, which stands for ratio utility billbacks. It's effectively taking an older property that might not be individually metered, and it's what's called a master meter. The owner or the landlord of the entire complex gets the bill, and they're not redistributing any of that back to their tenants. If you can find a property like that, there's a huge amount of opportunity and upside to pass along those bills or a portion of the bills to your tenants, called RUBS. That gets me really excited. It's not as common anymore because it's pretty low hanging fruit in terms of value add, and most other syndicators have, it's a very simple way to implement that with minimal cost. But that definitely gets it's a little nerdy, but it gets me excited. And then the other ones are just inefficiencies in the management. The payroll is high. The variable costs that are controllable at an asset level are too high, whether that's the repair and maintenance budget. Sometimes you see these owners blatantly getting ripped off, and you get more familiar as you look at more assets in a specific area, and you say, well, this particular line item for all the other properties was 20% lower compared to what this asset is running. Let's dig in a little deeper and see what's going on. And those little things not everyone catches, and that's the opportunity at the end of the day to increase your net operating income.
Gotcha. Okay. And if there were maybe one or two like best questions that our listeners could take away as an LP that they should just absolutely make sure to ask a sponsor before they invest, what one or two things would you recommend they ask to make sure their capital is just protected, if this is maybe their first deal?
Yeah. So as it relates to the T12 and everything we're speaking to here, not everyone is going to take the time to look through the model. For me, it's just my natural instinct and interest. It's a weird one. Most people find it boring, but again, talking specifically about the T12, I would say you want to at least ask for the sponsor's projections, just to take a look, and at bare minimum, see what kind of back into what they think this particular asset is going to receive in monthly income. And then maybe just hit up apartments.com or one of those local competitors and, hey, is this, type in a one bedroom, type in a two bedroom, just see if it's feasible. If it's way off the line, like we're going to get $2,000 in a market that's only getting $1,000 for new construction or something like that, it's a red flag. At least start there. Another quick rule of thumb is check the operating expenses that we've been talking about. Depending, it could range pretty dramatically, but on an older, 80s or 70s vintage, 50%, I would say is a good metric. If it's a lot lower, just ask the sponsor, hey, been curious about your operating expenses. Can we go through them a little bit? But those are probably two pretty quick and easy ones that anyone can check, and it's definitely worth the 10-15 minutes to look into those.
Awesome. Well, cool, man. Well, I appreciate you going through this. I think a quick hit piece of material people can listen to just to really wrap their mind around the T12 and send them down the right path when they're learning a bit more as they invest in their first deal. But yeah, appreciate you taking some time to chat with me. And guys, if you'd like, follow the social channels. We'll be putting them in the footer here in the description. But we're going to be making a lot of content like this just to help, break down just maybe confusion and just educate people on all these different things you need to understand as it relates to making an investment as a limited partner in a syndication deal whenever you're choosing your sponsor. So hopefully this was helpful, and we appreciate you guys tuning in today. Thank you.
Thank you. Appreciate it, Bobby.